On this morning's Ag Issues program, a pleasure as always to bring on to the program Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, and he joins us in studio this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine. Good to be with you.
Let's get right to it. You had a recent article, or as a matter of fact, a very recent article from Friday, I believe. Excuse me. And this is looking at what we're seeing with the Biden administrations on what they are looking at as far as the proposed tax changes are concerned. But in this article that you have, you put a percentage, or what you think right now is the percentage on some of the specifics, and there are a lot of them to talk about. So let's just start to dive right into it. One of the things we're looking at is the federal estate tax exemption as far as potential on where it may end up. And you looked at it as, could it drop to 3.5 million or could it drop to 7 million? So let's get into some of the things you're looking at and what the percentage you would put on that right now.
Well, your comment right now is on spot because this could be different this evening than what we say this morning. And this was a long sit-down interview with a lot of farm media, and it came out last Friday in farm publications. I think it was Farm Progress that actually is running it. And I had changed over the time that I granted the interview and sat down with them. I had changed the percentage by the time the article came out. So we had some last-minute edits based on what was happening in the tax writing committees. And the question on the exemption is the major question that a lot of farm families have. As soon as I get back to the house this morning, I have more phone calls to return that came in over the weekend of people wondering, well, what should I be doing now with respect to all of these potential changes? What's going to happen? And I do this at my 8-hour seminars. I'm taking 2 to 3 hours right now just to go through all of these proposed changes and basically take 2 to 3 hours to say, I don't know. I have no idea, but here's some things that we might want to think for clients that we can do just to be ready for changes that might come. And we may get some, we may get none, we may get more than some, we may get all. I doubt that, but we just don't know at this point in time. One of the questions that people have that is of a concern, and it's a combination of two, but the first part of it is, well, is the federal estate tax exemption going to change? Is it going to drop starting next year? And my answer to that is no. I don't think it. I think there's zero chance. You want percentages on it? I put the percentage at zero that it'll go to 3.5 million. I think that's not going to happen. Now, there's a higher probability that it would land at about 6 or 7 million. And in the article, I attached that at about 60%. So I think there's a 40% chance that nothing will happen, that it will not drop, that it would stay about $12 million. Now, keep in mind, if Congress does nothing, once we get to 2026, it drops to 5 million, but with the indexing for inflation, we think probably in 26 it would be about 7 million because it drops to 5, but then you factor in all of the indexing. So that's if they do nothing. If they go ahead and jump that and basically fast forward that to 2022, we'd be at about 6.5 to 7 million. There's a possibility that could happen. Now, for Kansas farms and ranches, how many are above the 6 to 7 million threshold? Well, the data that we have, I have IRS data. K-State has some data for farms in the Farm Management Association, and we're looking at about 20 to 25% of farms and ranches above 6 to 7 million. And once you get above 12 million, it's very few. But there are some, but the percentage is very low. So, yeah, that's a concern. And what can we do from a planning standpoint to deal with that if we're in that area of net worth, or we think we're going to be close to it in the coming years with appreciation and value and those types of things? Again, that depends on other things that Congress might do. Are they going to take away valuation discounts? Are they going to change the corporate tax laws such that that we can't do as much entity structuring and entity planning that we have done in the past? So there's a lot of interrelated questions on that. But I would put the chance that it's going to go to $3.5 million, 0 to 6 to 7 million, about 60% right now.
Now, two things. You can find this article, by the way, on farmprogress.com. It's entitled "Farm Busting Tax Changes." That is ? Possible, but unlikely. That's the title. And then you can go under the Farm Business tab on farmprogress.com. Now, you also mentioned it may change tonight. The House, or the committees in the House, did a lot of the legwork last week, and now it's going into the full vote, or I guess into the chamber as well. So now the big discussions begin on this.
Yeah, and that's true. And one major thing that happened last week, and you can see in my chart, the question as to whether step up in basis at death will be eliminated or modified. I put that at 0 because Chairman Neal on the House side realized last week he doesn't have the votes. And that is a big win for agriculture right there, because the ability to get a step up in basis on assets that go through a decedent's estate in the hands of the heirs to fair market value. Now, that could be stepped down, but we commonly refer to it as stepped up basis. That is incredibly important. That affects everybody. The exemption level only affects those that have net worth above what the exemption level is, and so that doesn't affect everyone. But the basis issue is huge. And it's important to us as practitioners also, because if we don't get a step up at basis at death, it becomes administratively very, very difficult because clients don't always have good basis information and good records that we can go back and track that basis. And, of course, the IRS presumption is if you can't establish what your basis is, then they're going to assume it's 0. And so we're going to start from 0. And that's horrible. That would create a lot of havoc in farm country. But that one is 0. The step up in basis modification rule, they're not going to do that. So that's a 0.
And I didn't realize this is not the first time this has happened. You go back to the Carter administration where that actually was approved, but then
it was repealed.
Quickly kiboshed.
Now the interesting thing about that is the current occupant of the White House voted for the change in the basis rule and then voted for the repeal and the change of the base up rule. So he's on both sides of the issue.
Oh, man. Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us. You find him on a recent article on farmprogress.com about potential tax changes, tax reforms within the Biden administration, and percentage as of right now of it happening by year's end. And we've talked about stepped-up basis, federal tax exemption changes. So let's look at income tax rates, specifically as we look at it for farmers. What are you thinking right now?
Well, the article quotes me at 40%. Let me clarify that a little bit. I think rates will go up. So if we're just talking rates, I think that's much higher than 40%. Now, the reason I attach 40% to it is because we have tools that we can use to lower the effective rate. So really I attach that 40% to effective tax rate because we can use income averaging. We can use deferred payment contracts. We've got other things that we can do to massage that income and move it from year to year and smooth it out to decrease the potential increase of tax rates. So the effective bottom line may not change, and that's what I'm really driving at in the article.
In other words, if you're a farmer, your CPA or your attorney is going to play a very important role in that, too.
Yeah, and, of course, there's a cost to that. So if we want to factor that in with increased tax rates, maybe the rate won't go up, maybe the effective rate won't go up, but your overall tax bill in terms of tax prep will go up. So, that's not a bad thing for the tax attorneys and the CPAs out there, but it's not necessarily great for farmers and ranchers.
All right. Another thing that was asked, percentage-wise, what are we looking at on the deduction for state and local taxes and whether or not that will be restored?
Yeah, I pegged that at 85%. Now, this is interesting. You hear the left always harping about tax the rich. Well, not too much, I guess, because this deduction hits the high tax states and primarily on the northeast corridor, the New York, Connecticut, Vermont, or not Vermont, Delaware, those states that are high income tax states. Then we can add in Illinois and California.
Right.
And those are primarily deep blue states from a political standpoint, and they're really upset about the $10,000 limitation that's on the deduction for state and local taxes that came in 2018 under the Tax Cuts and Jobs Act. So I do think that they will eliminate that. These states that are high tax states, high property tax states, have been doing what they call workarounds on that. IRS does not like that at all. I think there's a lot of political pressure on the left to eliminate that, and I think they will.
Now, itemized deductions. Question there is, are they going to be capped?
Yeah, I put that at 40%. When the article came out, probably today, I would put that at 65%. I think that's gone up over the weekend. And what that means is, of course, on our business expenses, the government partners with us because we can take a deduction for those business expenses. I want to put up a grain facility. I want to put up a barn, a storage facility, whatever the case might be. I can write that expense off as a business expense. I can get a deduction. Well, the deduction is tied to the tax rate that I'm in. So the government partners with you to an extent. So if I pay tax at a 25% rate and I've got a $100,000 business expenditure, I'm going to write off 25% of that. Well, the proposal is to cap the deductions at 28%. So if they increase the tax rates for me and I now go to 39.6%, I would only get a 28% on the dollar deduction for that. I think they probably will cap that. I think it's more than 50% chance. I put it about 65% right now that they will cap it.
A big one we haven't mentioned, capital gains, and what's going to happen with the capital gains rates.
Yeah, I pegged that when the article came out. I pegged it at 30%. I might bump that up a little bit right now. The capital gain rate will probably go up. That might have creeped up over the weekend to a little bit over 50%. And they're looking at an effective doubling of the capital gain rate. Our top end on that right now is 20%. If it's a passive gain, when you add in the Obamacare tax, it goes to 23.8%. The talk is to take the capital gain rate to the top end of the individual rate, which would then be 39.6. You add on the 3.8, we're almost to 44%. Then you add on state capital gains, it gets you to about 50%. That would be a blow. That would not be good. I think the chance that happens went up over the weekend just on some things that I'm seeing and some things I'm hearing from the tax writing committees. I'm not sure it would go to 39.6. I think they will increase it, but probably not all the way up to the top end of the individual, what would be the top individual tax rate.
I know many have heard the name Joe Manchin, senator from West Virginia. How important of a role or how important is that name going to be as this eventually comes from the House and gets to the Senate?
Well, that's a good question. I actually I keynoted a major farm conference in Iowa City, Iowa in late June. And I mentioned to that group, which was a large audience in person and then across the country, I concluded my commentary with all of this tax stuff by saying, pay attention to President Manchin. And I said that deliberately because he's the one that's in control.
Yeah.
He controls all of this. Senator Grassley said some of these things are going to be dead on arrival in the Senate. And he's spot on simply because Manchin, West Virginia is an interesting state from a tax political standpoint. You've got a lot of ag. It's not the ag we think of out here, but he's got a lot of rural voters in West Virginia. We also have a number of those on the House side. Some of this stuff's not going to make it, particularly a complete drop in the federal estate tax exemption. That's why I said that's zero. That's not going anywhere. Because you've got all you need, I think, Greg, is 4 seats in the House, 4 votes to switch in the House, and then your majority's gone. Well, you've got Southwest Iowa, for example. Cindy Axne represents a lot of farmers.
And who is a Democrat.
A Democrat because they gerrymandered the district to wrap in part of Des Moines. But she's already said, I'm not going to support this. And so there goes your stepped-up basis. That's why there's no votes for that, not enough votes for that in the House. And the same thing with the federal estate tax exemption. And you mess around with some of this other stuff, and you lose 4 votes and you don't have it in the House. And then you've got Grassley on the Senate side, and they only need one vote there to switch. And they're saying some of this stuff's dead on arrival. So your margins are so thin that they're not going to be able to do as much. The majority's not going to be able to do as much as they would like to do. Then we get into such things as the corporate income tax and the other extraneous things that we didn't have time to talk about today. We'll just have to see how those things go. But this is this thing is malleable. It's going to change as we get further down the road on this and we get into more of these debates. So we'll just have to pay attention to this.
Further down the road, and oh, by the way, midterm elections next year. So that further down the road, it's not the biggest window.
Well, that's the other point that I made at that Iowa City conference. I said, pay attention to what President Manchin says, and I still believe this. If they don't get anything done by the end of this year, it's not going to happen.
Yep, I totally believe that, too. One quick thing. We had this on last week's Ag Issues program. The IRS reporting proposal, $600, that's, I think, still in play. You're seeing more and more that says, I don't think we're going to do it. But then you saw Treasury Secretary Yellen say, no, we need to put that in there, too.
Yeah, Treasury Secretary Yellen is saying some things that the tax writing committees are not necessarily agreeing with. We'll see what happens with respect to that. If they drop that figure down to $600, that's pretty intrusive. The banks are not going to like that. It's very cumbersome. And depositors are not going to like that either. You have to report every transaction over $600. That's going to increase administrative costs. It's going to put fees back on customers of banks, and it's still out there, and the Treasury is pushing for it.
Not dead.
No, it's not dead.
All right. Sounds good. Roger, we're out of time, but as always, appreciate it. Thanks.
Thank you, Greg.
That is Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Laws. He joins us on the Ag Issues program here on 580 WIBW.